Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
All right, I'm back here on the Investor Coaching Show, Paul Winkler. Okay, so I was doing a video this week, and one of the things that I talked about is a common mistake that I see being made out there. And it basically goes like this. You go into a sales presentation, and that's what a lot of times these financial planning meetings are. And they may sound good because they sound like they're doing financial planning, but it's usually they're using financial planning as a sales tool is really what it is. And what you'll hear people say is like, well, you know, you need to have a couple different buckets. Sometimes that terminology is used. You have a couple of different buckets. You're going to have your risk bucket over here. That's where you're going to own your stocks. And, you know, I hear them say, well, you know, I heard something the other day. They're talking, you know, the down markets are an opportunity. They can be an opportunity is what was being said. And I hear that quite often. And, you know, I saw, matter of fact, a couple of articles in the Wall Street Journal, exactly the same type of terminology being used. It's an opportunity. You got an opportunity to do this. Anytime you hear the word opportunity, think you have the ability to market time here. Because what you're doing is you're saying it's low. You have an opportunity to go and buy low and sell high. Now, when you're regularly rebalancing a portfolio, it's not, you're just bringing portfolio back into the asset mix that it's supposed to be. So if you're supposed to have, you know, let's say that you've decided that you want to have 10% of your money in one asset category and 10% in another, and one has done just rocked and now it's 15% of your portfolio and the other one's kind of done languished and it's at 5, you're going to sell the 5 overage in the one and then buy the 5 under in the other to bring them both back to 10. That's simple. Now, opportunity, you hear that kind of that terminology when somebody thinks, oh, this is underpriced. And you'll actually see that in prospectuses, mutual fund prospectuses, that type of thing. You know, we look for opportunities in this and opportunities in this market. It's market timing. What do we know about market timing? We know that studies show it doesn't work. We know that, you know, studies of pension plans found that, you know, one study I refer to quite often because it was a big one, that 100% of the time when it was engaged, when they used it, it actually hurt returns. It didn't help returns. Well, I don't want to do anything that's not going to, it's going to hurt returns or is so likely to hurt returns that they have major studies where it never helped. That doesn't seem like fun to me. I don't know about you. So you hear that type of terminology, the opportunity to do this. So they'll say, I have this bucket over here. This is my risk bucket. And you have stocks or you'll have, you know, different types of investments that are supposed to be highly, they have capital appreciation potential. And that's going to be one bucket. Then over here, you need to have your safe bucket. And this is how it's sold. You have to have your guaranteed, your safe bucket. And a lot of times, what are they doing? They're putting in annuities. Because why? Because the commissions are wonderful on annuities. But the problem you run into is this. Is let's say if I'm managing that portfolio, now instead of 10% and 10% in my previous example, where I have 10% of my money in one asset category and 10 in another. Now let's say I've got 50% in stocks or whatever, stocks, real estate investment trusts were always exciting for companies in recent years. It's, oh, wow, you can get an income on this real estate investment trust. And then all of a sudden now real estate's just kind of, whoa, some real struggles in so many parts of the country right now. Really rough because the interest rate increases. And now, all of a sudden, why is it not selling this stuff anymore? I don't know. Why are they not selling it? Because it didn't work. But the problem is the people bought this stuff from them. And now they're stuck. Or they think, well, yeah, a lot of times they are stuck. But there are products out there that people have bought, you know, that you can slide out of little by little, but it is not easy, especially when you paid that big old commission on the front end. But back to this. So let's say that I have that other bucket that's supposed to be guaranteed. When I'm managing a portfolio, if let's say stocks do really, really well, then what I've got to do is, now it's not taking up 50% of the portfolio. They're taking up 60%. So now it's over what it's supposed to be. It's supposed to be 50%. It's at 60% of my money. And what would I do when properly rebalancing a portfolio? I would say, okay, I got to bring it back to 50. So I got to sell the 10% overage in my stocks. And now I take that money and I stick it over into the fixed income. What are they using as a proxy for fixed income? Annuities. Ka-ching, what do we got? Another commission. Now, great for the investment advisor, not so great for the client. Then what they do is this. Now the stock market's down. Now instead of 50% of my portfolio, it's 40% of my portfolio. Now what I've got to do is I've got 60% of my money in fixed income, and I've got to bring that back down to being 50%. So I need to sell some of the fixed income, which is funded by what? It's in annuities, because remember, the insurance company is just an intermediary between you and the end investment. So you put money in, the insurance company takes it and they reinvest it. They're in between you and the ultimate investment, and they've paid a commission. So if you leave early, if you take your money back out, you've got to pay a back-end penalty to get back out because the insurance company's got to recoup the commission that they paid to somebody. Now, here's the problem. If you're rebalancing the portfolio, you've got a back-end surrender penalty to take the money back out of the annuity and put it back over into the equities or the stock part of your portfolio. So it makes it pretty much next to impossible. Well, they don't do that. Why they don't? Because they know what I'm saying is right. They don't do that. So what you end up with is a portfolio that gets all out of whack from a risk-return trade-off standpoint. And here's the other problem, and this is the major problem. When you have a fixed income portfolio, your bonds, you're going to have different maturities. You'll have some that mature in less than 1 year, some in 1 year, some in a couple of years, some in 3 years, 4 years, maybe 5 years. And you have these different levels of maturity. And when stock markets do their fluctuations, you will find that the short-term stuff doesn't change much. It'll stay about the same value. Because it'll just pay whatever the interest rate was on it, and it doesn't go up and down significantly in value. Remember the Silicon Valley Bank thing I talked about. Silicon Valley Bank, the bonds went down in value. Why? Because interest rates went up. So what happened is when those interest rates go up, now you have a situation where your bonds go down, which isn't cool, which isn't good. But if you have a stock market decline, what happens when you have a big old stock market decline? Well, a lot of times it's because the economy has gotten really bad or they've gone into a recession and there's a problem. When that happens, what do you hear everybody talking about? You hear them talking about interest rates coming back down. When interest rates go down, what happens to bond prices? They go up. So in situations where we've had big downturns in the stock market historically, you will see that stocks drop in value and then bonds jump up in value. Now that creates the opportunity to rebalance the portfolio where now I can sell some of those bonds at a higher price and I can buy into stocks. Well, if I'm dealing with an annuity contract or something that's just a fixed income part of my portfolio, you don't see those big fluctuations. You don't see it jump in value just because the stock market went down, because those things are fixed and guaranteed. Now, maybe the insurance company is the big benefactor because they went and took your money and invested in those bonds, but you don't get that benefit. They just pay whatever they told you that they would pay, in those fixed contracts. So the problem that you run into is not only the liquidity issue in rebalancing the portfolio, but you also have the other problem in that they don't have that dissimilar price movement. Because if you look where you have actual opposite movement in markets historically, it has always been with stocks and bonds. And those more intermediate 2, 3, 4, especially 4 to 5 year bonds is where you see more of that activity. So that is just what? It's just you're being sold a product. It's a sales pitch. You have your risk over here. You have your fixed over. It sounds really good. And in reality, should you have fixed income? Absolutely. But to do it in that manner, no, it's a little bit better for the financial advisor than it is for the end investor.